Hello, fellow Rebel Capitalists. Hope you're well. I'm here with my good friend Lynn Alden, and we are going to dive into the depths of the monetary system. It's going to be a very fun conversation. Welcome to the show, Lynn. Glad to have you back.
Happy to be here. Always happy to come.
All right. Now, you did an interview the other day with Snyder and Peter McCormick, and the very first question, I think it was a great interview, but I think it got the interview off on the wrong foot because there's so many different definitions. So I think the first question was, does the Fed print money? And I think you got to get a little more granular than that because that can mean just an infinite number of things. But I think what most people really want to know is, does the Fed's balance sheet, or how does the Fed's balance sheet actually impact M2? Because, when you're talking about printing money, what most people are trying to determine is if that's going to impact consumer prices. And so we know that the amount of currency units that are chasing goods and services, you can kind of say that's M2. I mean, I would take it down for checking and savings because of high velocity money and low velocity. But overall, I think the normie is just when they hear money printing, or does the Fed's balance sheet increase, does that mean it's money printing? They're really looking at it in terms of how M2 goes up or down. Do you think that's accurate to say?
Yeah, I think so. I mean, I think that's also going to, at the end of the day, affect what prices do. So the base money, as that changes, that has various implications for other parts of the monetary stack. But at the end of the day, the amount of money in our account determines, what kind of spending power we have. And so at the end of the day, that transmission from base money changes to broad money changes, if any, I think is the key thing that people want to know at the end of the day.
Yeah.
And I think one of the confusing parts over this past, let's call it since the global financial crisis, that has thrown a lot of people off, is that they assume money printing must be inflationary. Whereas another way of looking at it is that it can be anti-deflationary.
Right.
That you don't so you don't assume that the base case is like roughly zero inflation. You might assume the base case is deflation in a certain type of environment, like a big debt bubble going off. And when you expand the monetary base, you set off a series of changes that prevent that deflation from happening, which is, it's another type of inflation, but it's not something we would generally think of as inflation.
Yeah. So to give a good example, let's say you've got Wells Fargo and they have, let's just say, $5 trillion in deposits. So those deposits are a liability of Wells Fargo. If Wells Fargo goes bust, the money supply M2 goes down by $5 trillion. So if the Fed steps in and bails out Wells Fargo, it might not increase the overall M2 money supply, but it'll prevent it from going down by $5 trillion.
Yeah, exactly. And that's what we saw during the Great Depression. So we saw that in force. And generally what these environments shared is that, leading up to the Great Depression and leading up to 2008, you had a situation where the multipliers were very significant, meaning that the number of deposits that a bank had that they owed liabilities in compared to how much base cash they had was very wide. Um, and also
But
how
how are
much
you measuring that cash?
different ways. You can either look at just deposits in the system compared to the monetary base, or you can look at deposits in the system compared to the amount of money that banks list as cash, which is either vault cash or bank reserves. And so
Yeah, but I think that
before,
there's more cash than that.
like, what other cash types are you considering?
I think there's off balance sheet cash that's just interbank lending.
Well, that's another type. And interbank lending went down quite a bit after the global financial crisis because
Right.
so what they did back then, I wouldn't consider that a type of cash. It's a type of interbank liquidity. And so one thing that these environments had in common is that the system became so leveraged but so efficient, so that very little base money could move around super quickly. Whenever a bank had any sort of liquidity problem, they could just borrow from another bank, and you never have like a system wide withdrawal, or to the extent that you do, it's super rare. Like it's very rare that 100 million people want to go and pull out 10% of their cash in the form of banknotes, right? That's a very statistically unusual phenomenon, usually associated with crisis. So normally what you have is banks, one bank might have a little bit of a liquidity squeeze, so it borrows from another bank that's not having a liquidity squeeze, and you have this kind of game of musical chairs going on where you're supporting a very large deposit base that all these people think that's their cash. They look at their account, they say, I got 50,000 in the bank, whatever the case may be, and that bank might have $1 trillion in deposits, but only has 50 billion in what they would have as cash. And any sort of other quick transfers, they would need to quickly borrow from another bank or use various operations to meet that. And I
Right.
think one just to finish up that point, I think the foundation at the end of the day is if you're on like an older money standard where say the money's gold, right? If something unravels this big debt environment, you can't print more gold. So you're going to have some sort of peg break. You're going to have some sort of deflation, either deflationary collapse or peg break. It's kind of your options start to condense down. Whereas what makes this money printing essentially is that now authorities have flexibility over the monetary base. So the third option is basically instead of a peg break, they can maintain those claims because they increase the monetary base and they make banks less reliant on interbank lending. But then it kind of retroactively makes all of their deposit growth and their fractional reserve banking, it kind of solidifies that. It says that is now, we've given the choice between M2 starting to collapse down closer to the monetary base or the monetary base expanding upward to meet M2. They basically say that we will always err on the side of, the monetary base expanding upwards to make most M2 money good.
Yeah, I think it's a bailout, but I don't know that it's a bailout because there's a lack of reserves or a lack of liquidity. I think it stems maybe from, it could be either or, but I think it stems from bad lending. If you think back to the GFC, and it is true that additional reserves kind of papered over the problem. That's unequivocally a fact. But was the real problem a lack of reserves, or was the real problem just a bunch of real bad loans? I guess that there's an argument there saying that if you made a bunch of bad loans, but if you had far more reserves in the system, then that wouldn't have been the problem. But it's trying to get at the symptom or the cause. You know what I mean?
So I think so at the end of the day, when you can look at like a stable system or an unstable system. So for example, stable system is like a chair sitting there. It's got four legs. It's just stable. Whereas a bicycle, it only works while it's in motion. Otherwise, it falls over, right? So that's an unstable system. It has to keep going to not fall apart. Same thing for like I don't know if it's biologically true, but like a shark has to keep swimming, otherwise it drowns.
Yeah, it's
Or
just one of those
or
things that's said so many times you just
yeah, I
assume it's
assume it's
true.
true, but I'm not a biologist.
Yeah,
Or a game of musical chairs. Imagine if you had like 30 kids and five chairs. As long as the music's going, it doesn't. You can have one chair. It doesn't matter. But when the music stops, the ratio of kids to chairs becomes a lot more important. And so what you generally have in these crisis environments is that you have an inherently unstable system. Like basically that no more than 5% of people could want to withdraw cash at once because there's really not the base cash isn't there. There's only so much base cash.
but
You can't.
that's based on counterparty risk. So
Yeah.
if there's
So,
enough, if the counterparty risk is low, there's infinite chairs.
well, not at once though. That's the thing because you
Yeah.
can't.
No, there is because assuming that let's just assume there's zero risk, right? Then the banks are going to be able to get liquidity from any other bank they want because the bank's balance sheet is pretty much infinite.
Well, any one bank can get liquidity from other banks, but
Right.
if the whole system's only levered so that there's basically like back in 2008, there were like 23 deposits for every $1 in what banks called their cash, which is like vault
Right.
cash combined with some reserves. Now, if any one bank, let's say one bank had 20% of deposits want to come out of it in one day for some reason, maybe they have a really big concentrated depositor. That bank could meet that no problem by going over to Wells Fargo and saying, "Hey, we just got to meet this like liquidity requirement." Um, but if the whole banking system were to one seize up, so they can't, they don't trust each other anymore, and
But
they
that's
can't.
an increase in counterparty risk.
Yes, but the reason it happens is because they realize like that the money's not actually there, or at least most of the money's not actually there. So if the music stops, and if say 10% of the whole deposit base shows up and says, "Oh, okay, I want my dollars right now," there's literally one is there's not even enough printed dollars, and two, even if you include reserves and things like that, there's not that many base dollars. And so
Right,
it's
but
it's
back,
it's all
but let's go
reliant
back to
on, yeah.
2007, because I don't know that in 2007 the issue was depositors going to the bank and wanting green pieces of paper. It's the fact that they had to take a haircut on the asset side of their balance sheet, so they just didn't have that liquidity because counterparty risk was so high. But using your analogy of musical chairs, if we would not have had those bad loans, the bad mortgages, then there would have been infinite chairs, because if they had a depositor that wanted to transfer their commercial bank liabilities to another commercial bank or even outside, the United States, they could have easily done that because they could have borrowed and got the liquidity they needed. Again, the way I look at it is just it's a symptom of counterparty risk instead of a symptom of not enough reserves. Although to your point, if there would have been a lot more reserves, then there would not have been as much counterparty risk.
Well, yeah, because I mean, I think the extremes help justify or help explain the averages. So, for example, if you had a situation where every bank had 80% of its deposits backed up by just cash in the vault, for
Right,
example,
right, right.
that's a very stable system. There's very little deposit risk that's possible. Even if all banks were just not trust each other anymore, the total losses would be pretty small.
Agreed.
Whereas if you have a banking system where they collectively have 5% of deposits on hand in cash, it's a system that requires that constant velocity, that constant. You always have to keep shuffling things around to meet whatever liquidity is being pulled in the system, and you can't really deal with the system-wide liquidity pull. And one thing that we see in general is, it's funny. They were having this kind of same discussion back in like the 1870s. Like William Stanley Jevons, if you read, he published a book in like 1875, and this was pretty recently after the widespread usage of telegraph, right? So the
Mm,
telegraph was deployed in the 1850s and 60s, and like in the Europe between all the different countries, and then the first transatlantic one
right.
was I think 1866 or like late 1860s. So by the time you get the 1870s, they're starting to really kind of use this ability to transfer money super quickly. And there's still obviously a lot of paper usage, but the combination of paper and telegraph was making it very efficient. And
Mm,
so this economist and logician was documenting it at the time in his book, and he was, on one hand, he was super excited about it. So he's describing how the more is like, we're getting so efficient at this. Claims for gold can move around so efficiently that you barely even need metal, right? Every once in a while, there's like a slight settlement that is some sort of like persistent trade surplus that you got to be able to move a little bit of gold. But for the most part, we don't even need metal anymore. It's just so efficient. On the other hand, he's like, we can't forget that all of these are claims for gold. And like, right now, as it stands, he's writing this in like 1875. He's like, right now, if 5% of people show up in banking hours and ask for their gold, there's not enough gold. There's only about 5% of supposed claims for gold met by gold. And he's like, so you have to be careful. And of course, we know that ran into a truck in World War One when that was kind of the music stopped, and there's only so much gold, and there's just a radically increased number of claims for gold. And
mm.
the similar situation happened in the 1920s US, where we managed to get through World War One, but then in that build up to the Great Depression, if you just look at how much debt was in the system or how much deposits in the system compared to the relatively small monetary base, and even the monetary base was only partially backed by gold, you had this like the stack was just so layered that it kind of had to keep going. And if you get a thing where asset prices fall and banks don't trust each other, that starts collapsing down to the monetary base pretty quickly because all that velocity just dries up. And it's not so much that only gets triggered by that counterparty risk question.
Yeah, that's what I'm talking about.
But
Yeah,
basically, what I'm saying is it's only so vulnerable to counterparty risk because of how highly levered it was able to get.
agreed. Yeah, yeah, totally agree. It's just I always I think we discussed this one time. I just try to think of it in terms of a broken engine that's and we all had them as teenagers, right? Or in our 20s when we were all broke, that consumed a lot of oil. I remember one time I had a truck that you had to put a quart of oil in it every time that you filled up with gas. And so is the problem that the truck's low on oil or, or is the problem that the engine is consuming so much oil? And that's what, you just try to think through. But the reason I try to really get into nuance there is because I try to get people to realize that if the banks want to, they can provide liquidity. They can create the dollars needed. They can create the cash. They can do all these things regardless of how many bank reserves are in the system. But to your point, that's going to depend on that counterparty risk. And if the system is over levered, there's going to be more counterparty risk, and you increase the probability that the Fed is going to have to come in and bail them out. But again, my point is I just want people to realize that banks, if they want to, if the risk reward makes sense, they can create those currency units. They can create that cash. They can create that liquidity.
Yeah, and I think, I mean, subject to certain, sometimes they're in environments where they have liquidity requirements like regulations or capital requirements, things like that. So up to a certain point. Um, but then even without those things, the problem is if you're running a bank, and you're a bank CEO and you want to run your operation such that, it's not like someone sneezes on your bank and your bank falls apart, right? If you can't go one day without like access to other banks' liquidity, then you're probably in trouble, right? So it you can always in a highly velocity functioning environment, you can always paper over any sort of liquidity demand that happens. But in that levered state, it's like there's a lot of imprudence in banks letting themselves get to that point where they say, we only have, let's say, 3% of the reserves on hand to
Right.
meet dollar requirements. And if more than 3% want their money back, or even transferred to another bank or taken out physically, if any more than 3% come, we have to rely on like the kindness of strangers, like other banks,
Yeah.
uh, our competitors, ironically, to have us not die tomorrow if this
Yeah.
happens. So, and whereas if you have 20% reserves, X, whatever the higher number is, you have a much bigger buffer that supports your basically your they're kind of inherently they're double counting because they're saying that, hey, you can always get back this whenever you want, even though we don't have it, but we'll get it if you need it. And you're double counting claims, which works until it doesn't.
Yeah. I think the real problem there, in my view, are the bailouts. So if you didn't have the bailouts, if the banks didn't think implicitly or maybe even explicitly that if they're large enough, the Fed is going to come in and create that base money, like you said, to bail them out, then I think we'd have a lot fewer banks that were levered to the hilt. I think there'd be a lot more prudence, to your point. So for me, that's really kind of the place to start, is the government interfering with the free market. And even going back to your example there in the 1870s, with that gentleman's book, you know, it was true. You had banks go bust, but they deserved to go bust because they took too much risk and they didn't have enough gold on hand. And, at some point, people show up and they want their gold and they don't have it. You get a bank run. But they didn't get bailed out. They went bust. So that sends a message to the other banks in the 1800s that, hey, there's no Federal Reserve. There's no government to come and step in to save the day. So I need to be prudent, or even more prudent, with my balance sheet. And then at that point in time, the depositors take a haircut as well. So then they're much more careful where they're putting their money. Instead of today, we have the complete opposite, not just with the banks, but the depositors as well.
Yeah, I think in an environment where either you can't or won't change the base money, then what you get is instead, anytime there's over levered IOUs and there starts to weakness emerge, the number of IOUs will collapse, not all the way, but closer to by some direction towards the base money rather than the base money expanding upwards. And so when that shock happens, people would say, well, I can't trust, I have to like dig into any bank I want to do business with to make, see what their reserve ratios are, to see how much fractional reserve bank lending they're doing, how much of this money is actually money.
Yeah.
The part that's not money, how safe is it? Is it at least like treasuries, or is it, what is it? Um, and they can go into that and analyze the risk. But generally, the problem is that every time this happens, it built up over decades. So if we go all the way back to the 1800s and kind of just go through these big, like not these like little bubbles, but these like generational bubbles that build up,
Hmm.
um, what you generally see in common is, the number of IOUs or claims expands for decade relative to the base, and that at point becomes so, like, it's if it's let collapse there, it becomes so like problematic that no politician is incentivized in the near term to let that happen under their watch.
All right.
And even if the funny thing is, even if they just tried to hold the line, let's say it's Ron Paul and he's like, I'm not going to do it. Well,
Yeah.
there's a good chance you're going to get voted out, and the next person's going to do it. So the political um, kind of calculations or just kind of the branching decision trees that happen in those moments tends to be very incentivized to always increase the base money, or at least eventually. Like even during the Great Depression, I mean, for years they didn't, and it kind of was just more and more banks are failing. Something like a third of all M2 was destroyed.
Right.
And eventually they were like, all right, we just got to print the money. Like it's just you can, 2008 they just did it right away, whereas back then they waited for a few years. But either way, it's like it kind of keeps moving towards eventually just printing the money.
Yeah, I mean, but then that goes back to, in a free market, do you have fractional reserve banking? Because it seems like, just as flawed human beings and flawed politicians with ulterior motives, we as customers, they want the highest interest rate. We want the cheapest loans. And if fractional reserve banking provides that, it seems like we as flawed human beings will choose that over and over and over again.
I think a general way that that's argued is that if the customers are opting for that, they at least have to be told what's happening. Whereas I think
Yeah.
in the current,
Yeah. Yeah.
they've done. I've seen surveys and polls and stuff that show most people don't actually understand how fractional reserve banking works. They
Yeah.
don't understand that the bank does not have most of their money there. Um,
Absolutely.
they might know roughly that some of it's lent out, but they might not realize that like 95% of it is lent out, and that only like 5% of it's backed by actual, some definition of an actual dollar.
Hmm.
Um, and so, it like if you go back to the 1800s during the free banking era, for example,
Yeah.
there are some countries that managed it better than others, like Sweden or Canada. The United States, because of our state structure, it was like every state had their own rules for like what, like so Massachusetts would say, I don't know, go run the bank however you want. Whereas like Louisiana had actually like really strict, like they were like, no, you have to have like 30% banknote backing by gold and XYZ and all these different things. And so
Mm.
some jurisdictions were a little bit tighter and taken more seriously than others. But then even if you were in a state that it didn't have requirements, if there was like a bank that like got through multiple crises and advertised that they're the highest reserve you know um, percentage in the industry, and
Yeah. They have that reputation.
then their reputation, and then maybe they can, there's obviously regulations one tool, but then there's other banks can self-regulate up to a point. And I think a challenge is just that the way it works is your fractional reserve banking is ultimately double counting. You're making promises that are probability based. So it's like, you're assuming that no more than X% of your deposit base
Yeah.
is going to want liquidity at a
It's like
certain
an insurance
time.
company too. Insurance, same thing.
Yeah, that if you were to have that's why they have clauses against like acts of God, they would call them. It's something like it's so catastrophic that it's just outside of their risk scope. And
Right.
that's how banks operate, where you know and that's where the Austrians would argue that in order to do it kind of like on the proper, you'd have to do duration matching, so that there'd be more customer differentiation between time deposits and demand deposits. Right now, demand deposits are the overwhelmingly large amount, whereas time deposits like certificates of deposit are a much smaller segment of the deposit base.
Right.
Whereas, and so you're kind of implicitly saying you can pull your cash out whenever, even though we're actually holding almost all of it in illiquid or less liquid assets of longer duration. The kind of the formal full reserve approach would say lending still happens, but that your deposits have to be duration matched to the lending you're giving out. So if you're making 2-year loans, that should be based on deposits that have a 2-year lockup. And that way, money's not, the person doesn't think it's all theirs anytime, while at the same time it's already lent out.
Yeah. I think that the key there for me is just you've got to disclose exactly what you're doing to the customer and to the depositor. And if you disclose that and they choose to continue to bank with you, even though you don't have that that time relationship in sync with the asset side and the liability side of your balance sheet. If they choose to continue to move forward because you're giving them a higher interest rate because they're taking more risk, as an example, then they should have the ability to do that. And then you just let the market decide. And if all those businesses, if they go bust because of some event, then they go bust. And then people say, hey, that was not a good idea in the future. I'm going to be more prudent with my money. I'm going to teach my kids to do the same thing and seek out these banks to where the asset side and the liability side of their balance sheet is more in sync from a standpoint of time. Now, that was one of the things that I didn't like about Silicon Valley Bank and First Republic and Signature and whatnot is, they said, oh, well, they're letting them fail. That means that everyone's going over to JP Morgan and they're becoming bigger. And I agree that that's not a good thing. You want a lot of banks, but if they come in and bail out, then there's no motivation for banks to get better. And there's no motivation for depositors to seek out banks that operate in a more full reserve fashion. You've got to have that failure sometimes to open up people's eyes and then change the way the free market operates.
Well, and the other criticism is that so far, full reserve banks haven't really been allowed to operate. I mean, it's kind of like, because the group of banks is what lets you into the banking system.
Yeah,
And
yeah,
if you do something that your competitors don't like, you don't get in. You don't get into the club. And
right.
so there was the narrow bank that they just said we just want to be a full reserve thin bank. They said no. There was Custodia Bank. They said we want to have all of our demand deposits backed up by reserves, 108%. And for other reasons they were told no. So there have been attempts that say, hey, we want to give the option to people, because right now, if you look around and say, what bank can I, would my demand deposits be entirely backed by cash? And the answer I think is none, or at least like
Right.
none that seem to be advertising that as something that they offer.
Or maybe just
And
offshore. I mean, that Schiff had a
yeah,
bank like that and they put them out of business.
yeah. And ironically, I mean, probably some of these stable coins are the closest thing you get where they're actually pretty heavily backed by things like bank cash and T-bills, right? They're actually ironically, but then they're in their own regulatory gray zone and challenges like that. Um, and one example we saw recently is these real estate funds that cut off redemptions, where they say,
Mm,
"Hey, I know you thought you'd be able to get your money out, but it's stuck in a liquid stuff, so you can't." Now, those contracts would generally have a clause in them saying that this is an option that they have, but of course, the key difference is you don't keep your payroll in them, right? You
right.
you don't keep money that if you don't get that month, if your redemptions are gated, that you're bankrupt now. Um, and so one of the challenges that for a lot of companies or businesses, or just people that have, just money needs, that there's no option for them to have their demand deposits backed up by actual cash, or at least like there's very limited options out there. You have to go to weird corners of the market to get them. They get
Other
shut
than just
down.
cash.
Yeah, other than just cash, which is in the modern era hard to run a business. Imagine you're running,
Right,
you have like remote employees and stuff.
right,
And so
right.
it's like you have to use a leveraged bond fund as your payroll, which is awkward. But that's kind of the environment we find ourselves in.
Yeah, yeah. Okay, let's go back to the Fed's balance sheet, how it does impact M2 and how it doesn't impact M2. Uh, let's look at this. And the reason I want to focus on this for most people is because if you assume that the Fed's balance sheet going up is always going to increase M2, the amount of currency units chasing goods and services, it's going to lead you to some inaccurate conclusions. One, the GFC that we talked about, you would have assumed that we would have had hyperinflation instead of anti-deflation, which I think is a great way to say it. Same thing for the 1930s. You would have assumed, oh my gosh, look at the Fed's balance sheet, look at what they're doing. We're going to have Weimar Germany. When in actuality, you still had consumer prices going down, although they didn't go down as far as they otherwise would have, right? If they wouldn't have done anything. But then in 2020, you were right to assume that the Fed's balance sheet actually did have an impact on the amount of currency units that were chasing goods and services. So I think people need to understand that back end plumbing so they can differentiate between the two types of quote unquote QE or the two differences in when the Fed's balance sheet expands or contracts. So, in your view, why did M2 increase as a result of 2020?
So two reasons. One was because some of the QE was from non-bank entities,
Right.
and two, because it was combined with unusually large fiscal spending. So a lot of basically the government spent a lot of money into the economy while almost simultaneously issuing a ton of treasuries. And if there was no QE, those treasuries, that issuance would suck money from somewhere, and then as they spend it, it would go back into the economy. And so you wouldn't really have a lot of money
But it
creation.
would have been the same thing if there was no deficit spending. Because
Yes.
if the Fed is doing QE, let's say, and let's just assume for a moment they're buying exclusively from non-bank entities via the primary dealers, then correct me if I'm wrong, but even if there is no deficit spending, that's still going to increase M2.
Yeah, that's why my first caveat there was if you're
Yeah,
doing QE from non-banks. So even without a
yeah,
deficit, if you're just doing QE from non-banks, the thing is, I think in most contexts that would not be super inflationary because, for any, if you're just recipient, you're not getting stimulus checks, you're not getting PPP loans that turn into grants, you're not increasing your net worth. You're a financial institution or you're some sort of investor, and you're giving away like a bond or security, and you're getting cash
right.
for it.
Bingo.
So M2 is going up in that context, but generally not super rapidly and generally not in a very price inflationary way.
Because it's
Uh,
low velocity. So let me explain that real quick, Lynn, because I think that's such a key component. That's such a key factor. So what she's saying, guys, is let's assume that you have $100,000 in savings, or excuse me, let's say you have $100,000 worth of treasuries on your balance sheet. It's a cash equivalent, but it's just sitting there as an asset. Let's say that you sell that, and because you want the $100,000 in your savings account instead of the treasuries. Okay, well, if that money stays in your savings account, although it does increase M2, it's not out there chasing hamburgers and groceries and rent and cars and whatnot, because it's just kind of trading one cash equivalent in your savings, being T-bills, for another cash equivalent, which is just the cash in the savings account. So I think that's the point you're trying to make there, isn't it, Lynn? And that's where I kind of try to differentiate between high velocity money, low velocity money, and then also the aggregate balance sheet of the non-bank entities. Because in that example, yes, the Fed increased M2, but it didn't change the assets as far as an aggregate total on the balance sheet of the non-banks.
yeah, it increased its own assets. It increased both its assets and its liabilities, so not its own equity as a central bank. And then other entities also stayed the same. When we talk about velocity is tricky because you can have velocity of different types for different markets. So, for example, one thing that QE can do is increase velocity on asset purchases, right? So, if you create reserves and buy existing securities from a non-bank, and they now have more money in their account, and they say, well, what are we going to buy with our more money? We're going to go out and buy some sort of assets. Maybe we go out and buy um, bonds. Maybe we go out and buy stocks. We're going to probably go buy something. So you're kind of in potentially likely leading to asset price inflation in the sense that you're increasing liquidity for entities that are likely to buy assets if they have more liquidity, or at least
Yeah,
replace the assets that they sold to the Fed. Um,
yeah.
because
Where I
most,
always
yeah,
where I always struggle with that is that I think about an individual that has those treasuries, right? And let's say they want to buy stocks. They're going to sell those treasuries and buy stocks regardless of whether or not they're selling to the Fed or they're selling to another non-bank entity or JP Morgan, right? And so I don't, that's where I kind of struggle with that. I get it that there's more M2, but I don't know that it directly impacts stock prices as an example, because it assumes that there are no other buyers. And if that individual wanted to trade the treasuries for stocks, they couldn't do it unless the Fed was buying.
yeah, I mean, and that showed up, for example, in March 2020,
Yeah,
where
right,
if you
right,
tried
right.
to sell an off-the-run treasury, you'd actually it kind of went like no bid at one point.
Right.
You'd
Right.
see that during the gilt crisis last year. You'd see it during the 2019 repo spike. So there are times of tight liquidity where it actually is hard to sell what should otherwise be a liquid asset. Um, and other than that, it's generally just replacement. So, if the Fed says, "Hey, we're gonna buy treasuries," and treasuries flow to them with a mild markup, middlemen taking their cut along the way, it just basically then those balance sheets go out and refill more of what they probably already had. And so you're instead of if the treasury was issuing a lot of treasuries and they
Yep.
were kind of filling up, they were getting stuck on all these like different entities' balance sheets, and they're all getting kind of tight on liquidity because they're stuffed full of treasuries. Instead of more incoming supply running into a tight liquidity environment and potentially causing one of those moments, instead that it kind of all the passengers get off the train. They empty out of those into the Fed with the new
Yeah. Right.
reserves, and then those can now reabsorb the other incoming supply.
Yeah. You've
And
got that release
yeah,
valve.
yeah, and
And
so that's yeah,
and let's also discuss too how, let's just forget the Fed for a moment, forget QE, and let's just talk about how deficit spending can create additional M2 money supplies. So I mentioned to you on a tweet the other day that I thought you'd find interesting about World War II in the 1940s, because I know you've done so much research there. And I was reading a summary of 1945 from the Federal Reserve themselves, and they talked about all of this deficit spending that the government did between 1940, I think maybe 1944, 1945, to fund the war. And they broke down the numbers, and they showed how, I think it was 382 billion total, something like that. But they showed the percentage that was purchased by banks and then purchased by non-banks. And they made the point to say that all of the treasuries that were purchased by the banking sector actually added to M2 money supply. And so even if you exclude the Fed, if the banks are buying or lending to a non-bank, which would be the government, you are going to see an increase in M2.
yes, that's true. And that you have to start from a position of generally pretty high liquidity or reserves, because if they're already running at say only 3% of deposits are backed up by cash, and then they want to absorb billions and billions of new treasuries, or today it'd be trillions, that'd be very hard for them to do while still being able to be liquid enough. But if they start from a period of like high reserves or plenty of liquidity, and they absorb that treasury issuance, that is directly accretive to M2, because those that money is being put into the economy, and it's not coming out from someone else's account. Instead,
Exactly.
it's the money multiplier itself is increasing, um, and so you're getting that M2 increase. And so in the 1940s case, that was like the highest ever ratio of treasuries held by banks. Like if you look at
Mm.
banks, like the percentage of their assets that are in treasuries, the
Yeah.
40s or 50s, I don't know exactly where it peaked, but that period was the highest like ever. Um, and because they were the principal financiers of the war, and the Fed 10x their balance, their like government treasury holdings between 1942 and 45. You also had the public was buying war bonds, stuff like that. So they kind of put the treasuries in whatever pockets of the balance sheet they could find, but banks were a giant piece of that. And if you looked at how England did it, I've looked into some of the war financing that happened for them, and for them the World War I is interesting because they kind of they're the global reserve currency at the time,
Mm.
and they said, okay, we're going to enter this war, because so World War I at the time was not expected to be some big. It was going to be in any other regional conflict.
Right. It's just going to be
So
like a 1 month deal.
yeah, it's supposed to be small, and it's like just like today with America and China, they're so intertwined. Germany and UK were so intertwined, even though they were kind of like Germany was the rising power. They had tensions, but they were so intertwined in terms of business and trade and finance and stuff. Like they were like, oh, this can't possibly be a serious war.
Right.
And so when the UK decided to enter the war, um, they wanted to issue an amount of bonds that was equal to like 100% of GDP. Like it was like a huge amount of bonds, and they said, "Hey, we're going to issue all these bonds to go fund the war," and only something like a third of the bonds were basically supplied. that there basically was insufficient demand for those bonds. So it came in way below expectations, even though those bonds had a higher interest rate than their normal government bonds. And so they had a dilemma. They basically, if they let that be known that that happened, they're probably not going to be able to enter the war, and the price of those bonds is not going to do well, and they're going to have a big problem. And so
Mm,
instead, they basically cheated. They had two high officials at the Bank of England borrow. They borrowed money from the Bank of England, bought the remaining 2/3 of the bonds, like under
mm,
their name with central bank credit. And so it was kind of this middle way of getting around the legality of deficit financing, like monetization. But they basically monetized the bond issuance, and so that's part of why they got such a big spike in overall currency, because they just created, essentially they created new base money to finance a large portion of what they spent on the war. And so, yeah,
yeah,
you get that. Just when you have moments like that, that's where you can get a huge increase in the money supply and a huge increase in actual price inflation, because that money's then, they're giving it to soldier salaries. They're buying commodities with it. They're going to
yeah, yeah,
manufacturer and saying, hey, stop making cars, start making tanks. We're going to buy them
yeah.
all. So then cars become expensive and metal becomes expensive, and there's more pounds out there, dollars out there chasing, goods.
Fewer
Yeah,
goods,
often
because
it's fewer. Yeah.
yeah, as far as from a consumer standpoint,
Yeah,
it's
yeah,
interesting to go over that story and juxtapose it to the United States with World War II, because such a large amount of those treasuries were absorbed by the general public. I wish I had it right in front of me. I think it was like 40% of the money they spent on the war came from taxes, additional taxes, and then between the other 60%, I forgot what it was. Let's say 30% uh, was bond issuance that was purchased by the general public, those war bonds, and then the other 30% was from banks, which obviously, like we said, impacts M2. So it seems like they had an easier time of it than Britain in World War One.
yeah. It was overall more diversified, and that's why, despite the fact that the U.S. had very high inflation during the 40s, it was not nearly as bad as what you saw in much of Europe, especially on the losing side, of course, but even on the winning side.
In World War One or World War Two?
Generally, both. Both of them experienced inflation that was generally even higher than what the U.S. experienced in the 1940s. We also
Oh,
experienced
okay.
we had an inflation spike during World War One as well. We didn't have to break our gold peg.
Hmm.
But we did have a big uptick in prices that, prices spiked briefly, and then there was like a brief period of deflation, but they
Yeah.
stayed at like a much higher average plateau. So we had like a one time, because there literally was more money in the economy, even though it was just a little bit less backed by gold than it was before, but the peg didn't break or anything. So prices were higher, and that was the state we were in roughly until we ran into the Great Depression.
Yeah. Let's go back and explain to people who are listening why, when the government deficit spends, if a non-bank entity is buying the debt, how it does not increase M2, and if a bank buys it, it does increase M2. Because I think, you and I talk pretty fast because we understand that back in plumbing, but I think that's kind of going over people's heads. I think it's a crucial component here, because what I really want to drive home to people is that if a bank is buying or lending to a non-bank, even the government, it's going to increase M2, and then vice versa. So just to be clear, guys, when let's say the Treasury issues $1 billion of the Treasuries, and that's purchased by non-bank entities, just the average Joe and Jane. So what that's doing is that's drawing down M2 to begin with, because they have to pay for those treasuries. So then what happens is the bank reserves go into the TGA, then the TGA spends those, let's say the bank reserves, those go back onto the balance sheet of the commercial banking system, and then M2 is replenished. So you have an initial drawdown in M2, and then you have an increase in M2 when the money is spent by the Treasury of the exact same amount. So on net balance, there's no change. But when you have a bank that buys that, so now, like what Lynn was saying, there's no initial drawdown in M2 because most likely a bank is going to use bank reserves that are a liability of the Fed. So that is not included in M2. So you have M2 stay the same, but then when the Treasury spends it, it increases on net balance. And that's the difference because the initial drawdown or the initial payment, if it's a non-bank, draws down M2, where the initial payment from a bank does not. Can you explain it any easier than that, Lynn?
I think that was a good way to do it. I think we can add an example. It's just that sorry, I have lawnmowers outside. I don't know
No
if you can hear it
problem.
on the mic, but if let's say the government wanted to send me $1,000 stimulus check, now if when they issue the treasuries, if you buy $1,000 of treasuries, then basically my bank account goes up by 1,000, my deposits, and your deposits go down by 1,000, but you get the treasury. And so the actual money supply didn't change, and the only thing changed is that now there's more treasuries outstanding. So that's an example of it not changing. On the other hand, if the government sends me $1,000 stimulus check, and instead of you buying the treasury, if one of our banks buys the treasury, what they're basically doing is they're leveraging themselves up a little bit more. The money multiplier, or like different ways to look at it. Um, the divide, that's a number that's fluctuated significantly over the decades. Is basically how much M2 is in the system compared to the monetary base or reserves or however you want to measure it. They're just levering themselves up more. So I'm getting more money, you still have the same amount of money, and so there's more money on net in the system.
Yeah, yeah, yeah. Very well said. So, what do you think about? I don't know if you've given this any thought, but RFK came out the other day and said he was very, very vague, but he said he was considering, if he's president, he's considering backing T-bills and the dollar. I'm not quite sure how that would work, but T-bills and the dollar, like a 1%, a Bitcoin or Bitcoin gold, silver kind of combination. And I applaud him for even acknowledging the monetary system and inflation and whatnot. But I got to thinking about that. I'm like, I don't know how that would work because, if you're saying, all right, we're going to peg the dollar to Bitcoin at a 1% backing at, let's just say, now all of a sudden the dollar is worth 1/30,000th, if I'm saying that correctly, of a Bitcoin, assuming we're attaching it to a $30,000 price, right? Isn't that just going to lead to an arbitrage opportunity where the outstanding Bitcoin, or in other countries, they're going to slightly bid up the price, but no one's going to buy that because they could always just buy from the Fed or the Treasury. And then it's just going to immediately drain the reserves that the Treasury had, regardless of whether it was platinum, gold, silver, Bitcoin. How are you seeing that?
Yeah, and I didn't look at the wording of the initial announcement, but I saw people
It's
debating on
very
it.
it's very
Yeah.
vague. They just say backing. They don't say if that's redeemable. They don't
Yeah.
give any details.
Yeah, that's the thing, because there's a difference between reserve accumulation and actual backing. So reserve accumulation would basically say, okay, our Federal Reserve is going to be, and Treasury, actually more specifically, is going to be allowed to and even tasked with increasing its hard assets, right? So you say, okay, instead of just holding our 8,000, supposed 8,000 tons of gold flat, we want to go out and buy more. And, we want to add a certain percentage of Bitcoin to that mix as well, so that there's more reserves in the system. That's one statement. I think it's an arguably reasonable thing to do. I mean, it's probably dollar negative while it happens, um, but then they'd have more ammo if they should ever want to defend the dollar. That's just generally how emerging markets manage their exchange rate. Is they either one of the things they do is expand reserves or contract reserves. So that's an option. Now, if you actually wanted to back it in terms of redeemability, the challenge is that you have to have quite a lot of it. So
Yeah,
the way this
yeah.
would work on the gold standard, for example, is that you might have 40% of your monetary base backed up by gold. And if there's too many redemptions happening, that's what you'd have to increase interest rates, because you want to entice more gold to enter into or at least you want to stop the outflows and entice more existing gold to come back in. for people that say, okay, I trust the system and I want to get that higher interest on that gold by depositing it. And then if they're ever in a situation where they have more gold than they need, let's say they have 50% and their mandate's 40%, they can cut interest rates because it doesn't matter if there's a little bit more redemptions happening. But you can't generally do that when you're talking about 1%, 5%. And the longer term challenge goes back to our earlier point about fractional reserve banking and how these claims tend to proliferate faster than the underlying base can.
Right.
And so when you have banks that are not full reserve banks, so they're not doing duration matching, they're doing fractional reserve banking, they're generally increasing the total claims in the system more than gold's increasing. And so as long as that's redeemable, you're probably going to get drained. If you look at the Bretton Woods system, it's interesting because it was proposed in obviously 1944, but it wasn't fully implemented until the late 1950s. That's when like it was fully set up. The exchange rates were um,
We're
like all,
locked.
all yeah, all that stuff was like it was kind of all planned for like that first like 15 years, and then it was like okay, we're going live. And if you look at U.S. gold reserves, they just started dropping almost every single year like a stone.
Yeah.
As soon as you had that, until it just broke. Then they said we can't do this anymore. So a lot of people, when they look at the Bretton Woods system, they say the problem happened in 1971. It's like, well, no, the problem happened the second you went live with a system that didn't fundamentally make sense because you didn't constrain the number of IOUs, bank deposits. You didn't constrain the number of euro dollars. So you had fractional reserve banking built on fractional reserve banking. This was all
No
proliferating,
reserve
and
banking,
yeah,
for
and
heaven's
all
sake.
this was yeah, and all this is now redeemable for gold. And so people kept saying, "Well, I'll take the gold then." So you started rapidly draining gold while increasing M2 and increasing euro dollars, and eventually the ratios got silly and broke.
Yeah, that's why I did a video on this last night, and I was just thinking about it out loud. And I love the idea. I love the concept. I love the fact that he's talking about it. Hats off to him because no other politicians are. But in reality, there's almost a zero probability that would work because, to your point, it just immediately get drained, especially to 1%.
Yeah, I think the way to think about it long term is that if the number of claims are expanding faster than what they're redeemable for, that's inherently going to break eventually. It
Yeah.
now then it becomes a question of when. I mean, if you start from a sufficiently high percentage and you're lucky and it's not tested very much, it can go for quite a long time. But if you start from a low percentage, and if people want to test it more, then it's going to probably break pretty quickly, like it did, like Bretton Woods did.
Yeah, exactly. All right. Well, let me go down my list, Lynn. While I'm doing that, why don't you tell people about your new book? I mean, this is very exciting. You've obviously done a ton of research on it, and I'm really, really looking forward to it. So, when is it coming out? Where can people get it?
So I'm planning on launching it in late August, early September. We'll see the exact date, but around that time frame. And probably it'll first be available on Amazon, and then it'll spread from there to different types of bookstores.
What are you going
And
to call it? What's it about?
so it's called Broken Money, and it's kind of there's two goals with it. One is that the main kind of question is, why is our money system not working as well as we think it probably should in the 21st century? Like, why is our
Yeah.
money, why is inflation happening? Why are bank failures happening? How come emerging market currency, like if you're just trying to save money in an emerging market, it's just harder. Everything's harder. Um, and basically the system's just kind of inherently unstable. So it tries to answer the question why, and to do that, it basically says a lot of this is technology. So let's start from the beginning of what money is and how new technologies have changed over time, what we use as money and how we interact with money, to see
Hmm.
how we got to this point, to see what about it might be unstable, and then what future technologies might be able to give us a more robust system. So everything from shells to Bitcoin, it kind of covers that spectrum, but it does it in I focus on a couple aspects that I don't really see other books focusing on,
Yeah.
which is a lot of it's that technology angle. I also obviously, banking now seems basic, but the development of banking over time was a technology. It was an emergence of different ways to abstract money, to send money long distances, different techniques that were used, even things like the invention of papyrus or the invention of paper were literal technologies that then allowed for these systems to develop over time.
Hmm. Yeah. Oh, one thing that I got a couple minutes here, maybe people would, first and foremost, people really want to know your prediction or your base case for consumer price inflation, probably over the next 6 months, the next year. And then just quickly, we've got this problem of the CBDCs, because what you're saying with, the delta between base money and broad money, unfortunately, a CBDC solves that, because broad money is base money, and it's everything's on the Fed's balance sheet, so they can't go bust. So you de-risk the system at obviously the cost of Big Brother and everything else that we're rightfully concerned with these CBDCs. So I guess why don't you start really quick with your base case for the next 6 months or year with inflation, and then maybe give me your quick thoughts on a CBDC.
So I think we're still in a disinflationary trend. I think the key thing to watch, though, is what happens with energy. To the extent that we have a second inflation spike, I think there's a good chance it would be energy driven, or a combination of large deficits and energy pricing. So right now, for example, U.S. Shale production, um, even though the production's still high, the drilling is rolling over, and that tends to lead production by anywhere between like 8 and 15 months, and we're something like 8 months into that, um, that rollover happening.
Yeah.
And so I think basically we're going to see kind of a tightness in supply, and we already might be seeing a tightness in price as well. I mean, the SPR is no longer drawing down. Um, shale, I think, is just going to be a little bit less flexible oncoming supply source than it used to be. So, I think most categories, I think, are still going to be kind of like muted for the next 6 months. But I do think we might be seeing early signs of energy starting to tick up. And I
Mm.
don't know if that's going to go up and then flatline for a little bit. I am bullish on energy this decade.
Yeah.
But if I try not to do things like predict, what's the price going to be 6 months from now, 12 months from now, that's partially depending on Fed actions, Treasury actions, geopolitical,
Recession, depression,
yeah,
black
recession,
swan. Yeah.
war. So, but I do think that that's the variable to watch. I think a key thing I like to do is make sure I'm asking the right questions or looking at the right things, so that even if I might not have an answer yet, I know what I'm looking for that might start to solidify me towards an answer one way or another. And so for me, I
Mm.
think energy is one of the key things I'm watching, in addition to just what's happening with the treasury, like the deficits and how those are being financed over time, and what happens when, for example, the reverse repo is largely drained. Where would the next source of liquidity come from? And you could get an environment where they have to redo QE, even if there's an above average, inflation number, kind of like how you see in Japan right now. Inflation's above their target, still doing QE. I think we eventually probably get to that in the U.S. It's not very close. Um,
Mm.
the longer term question about CBDCs, I mean, so the good news so far is that countries that have tried them, like Nigeria, have not had great success. Um, like they launched their e-naira, and after like 12 months, they had like 1% adoption, if that. Like more Nigerians were using Bitcoin and stablecoins than were using the e-naira, which is like by like an order of magnitude. And so that was promising. But I do think that some jurisdictions like China will be more probably successful with it, unfortunately. Um, the US is a tricky one because we have a slightly more decentralized system, in the sense that our Federal Reserve is kind of that hybrid public private setup, and banks generally don't want to be intermediated. And so, and Congress is pretty split on this issue, right? I mean, a lot of Republicans, I think, would they're making anti CBDC kind of, some of them are making it part of their campaign.
Yeah, but the
Um,
problem is they don't even know what it is. Those politicians, they're
yeah.
they're just complete idiots. I mean, they don't even know what a CBDC is. They wouldn't even know it if it hit them in the head.
I think a lot of them don't, but I think that when push comes to shove, if they do try to make a big change to the base money, how the base money works, and
Yeah.
you have to get something through Congress, I don't think we should take it as for granted that it will go through. I mean, it's possible that it will. When we think of, a lot of people, when they think of big monetary changes, they think of FDR. And what we have to remember is that FDR had like a super majority in Congress. That was like a huge wave that came in. Um, and it's one of the most concentrated American politics ever was,
Mm.
and they were able to do big changes. Um, And so we're not really in that environment today. If anything, we're kind of known for our record polarization for the past decade or more. And so I think it'll be kind of this like slower battle to see what's there. And I think in the meantime, things like Fed Now,
Yeah.
they give basically the Fed part of what they want from a CBDC
Right. Right. Right.
without breaking the bank lending model, right? So they don't want
Yeah.
to impair
And,
credit
and
formation.
without going through Congress,
Yeah,
because the deposits still aren't on the Fed's balance sheet. The retail deposits still aren't on the Fed's balance sheet.
yeah. So that for them is like the low hanging fruit because they could just do it unilaterally. It's just tech
Yeah. Right.
upgrade. Um, and what they do get from it is a little bit more fine tuned surveillability and controllability, rather than just seeing these large batching transactions. So I think that they might be content with that for a while, unless there's a window in Congress that might make a full on CBDC more likely to materialize.
Yeah. I think my concerns there, the way I see it playing out is, if I'm the Fed, if I'm a central planner and I want a CBDC, I'm not going to announce it. I'm not going to say, "Hey guys, we've got this new Fed coin," because I know that it's got a lot of negative PR. I'm just going to roll out the features. I'm going to say, "Hey, check this out. Now you can go ahead and transfer money anywhere in the world free of charge instantly. There's settlement 365, 24/7, yada yada yada." And then people, "Oh man, I love that. I love that. I love that." And just roll out these features, keep rolling them out. And then if we do have a crisis, especially in the banking system, the obvious solution is, well, okay, we don't want the depositors to take a haircut. We've got the FDIC with 180 billion or something like that. We've got deposits at 18 billion or a trillion, excuse me. So the easy solution is just to move everyone to the Fed's balance sheet. No one has to take a haircut. We never have to worry about the banking system being fragile again. And oh, by the way, the Fed's happy to pay you the same interest rate they're paying Jamie Dimon. Because right now, let's say you can get 1% with JP Morgan, but then they're paying JP Morgan 5%. People see that as unfair. So they look over, well, why would I not move my deposit liabilities from Wells Fargo over to the Fed, especially in a crisis situation? And that's when they've kind of sealed the deal, so to speak.
Yeah, and I do. So right now, generally, when you see CBDCs being launched in some of these countries, they do market it as increasing financial inclusion, faster payments. They're always obviously focusing on the upsides for the consumer rather than all the downsides like the surveillance, the control, things like that. And so I do think that they would have probably a similar approach should they launch that. I think the challenge is that when you're making the claim, or when they're making the claim, hey, you can get the interest that J.P. Morgan gets. You have to remember that bank lobbyists are quite a big force in who they pay in terms of politicians and stuff like that, which again makes it hard to get these more fundamental changes through Congress, right?
I
So
think they'll
something.
just be originators, Lynn. I just think they'll be loan originators, just kind of like with Fannie and Freddie. If Wells Fargo issues a mortgage, they're pocketing a spread, but then they're selling it to Fannie and Freddie. They're basically getting a fee, like a finder's fee almost. And if that's where they're making the majority of their profit along with trading, so basically what I see is the Fed gives them kind of a checklist like Fannie and Freddie, that the borrower has to meet this requirement, this requirement, this requirement, this requirement. And then they go ahead and do that regardless of the loan. And then they just sell the loan to the Fed. It goes onto their balance sheet, and the Fed pays them a spread, which would be the upfront profit that they would have made by keeping the loan on their books to begin with. That's kind of how I see it playing out.
Yeah, and I think that's a reasonable outcome. I mean, like a reasonable probability assessment to have. The challenge, you still have to get through legislation for that type
Yeah,
of
right,
change.
right, right.
So it's hard to predict the timing of that. I think even Jerome Powell's on the record of not being a fan of CBDCs. Neil Kashkari. I mean, obviously these things can change, but when you have officials like that, be skeptical of it. When you see some percentage of politicians make it an active part of their thing, when push comes to shove, the question is, can it get through like a filibuster, or can it get even half the votes? And it's unclear to me.
Yeah,
But it's something that I monitor, and I have a chapter in my upcoming book on that where I talk about, it's kind of a fork in the road here where money's clearly going more digital.
yep.
And the question is, is the proliferation of open source money like Bitcoin going to be more successful, or is the proliferation of closed source digital money going to be more successful, like the CBDCs or highly controlled stable coins, things like that, versus the open source. So I think
Uh,
that's kind of the I think direction things are going to trend to over the next decade.
Do you have another 5 minutes?
Sure.
How, let's assume that we have a CBDC tomorrow. How would you, Lynn Alden, navigate that? Or how would you suggest, assuming that the person listening right now wants the central planners to have as little information on what they buy in order to give them a social score, how do they, like, what strategies do they use? Because I've thought about this on a whiteboard, and unfortunately the conclusion that I come to is you're going to have to, a part of your finances is going to have to live within this unified ledger, let's say, or within this ecosystem, because how are you going to, how is your employer going to pay you? And if you wanted to exclusively use Bitcoin or gold, okay, well, then you'd have to find an employer that's willing to pay you in that. Then you need to find producers of goods and services for everything you need that are willing to accept that as a form of payment. And although that may be there in the future, it's definitely not there right now. So how do you, like, what would you do as far as a strategy? What would you suggest for the average person out there, assuming we got a CBDC tomorrow?
So I think for one, I would not really hold much more in it than I have to for like
Right.
liquidity purposes,
Yep.
which is kind of similar to how I do it now. I would just probably be tighter on that number because that I already can. It's like in some ways that money is already not yours. You're like you're the bank owes you a liability. It'd be like even more along those lines where like your access to it's always kind of in question.
Yeah. Right.
Um,
Right.
so I in some ways I'd operate similar to how I am now. Now the question is you can have different scenarios. You can have a CBDC that's not at first heavily used differently than how it is now. So maybe they're not blocking any transactions. Maybe they're not doing, quotas or what, whatever the case may be. And so it seems like business is normal. So behavior does not change much. I think generally when if you do start getting things like, hey, you can only buy 1 pound of beef per week and you've already exceeded your quota. And so you're going to be throttled back on that type of purchase for the next week. If you do start seeing things like that, I think that's where you could, right. There's already, for example, right now, there's like the beef initiative where they link like, grass-fed cow, like small farms, with buyers, and they have Bitcoin as one of the payment options. And so their whole thing is like know your rancher, establish connections with the people you buy food from, so that there's just fewer intermediaries. And so, for example, in that environment, you can say, "Hey, my CBDC, I can't buy beef, so I'm going to go ahead and actually use this Bitcoin to buy beef service as an option." Now, obviously, then the federal government could say, well, you're not allowed to accept Bitcoin as payment, but
Or buy
that's
Bitcoin or buy
or
gold.
yeah, but that's a whole nother legislative thing that they
Right.
have to go through. So the whole
Right.
point is make it hard for them, right? And then even if they say it's illegal, it's like, well, some people are using it anyway, so it's like kind of like civil disobedience. And then the question becomes how severe are the consequences? I
Yeah.
mean, right
Right.
now in Europe, I mean, in France, I think it is businesses are not allowed to accept more than like 1,000 euros in cash,
Yeah.
um, and it's hard to enforce. But it's there's a stick there, so if you get caught doing it, you could be in trouble. Um, and so that's and the average person is probably not being heavily impacted by that because most people are not super concerned about privacy. That even if they are aware that it's being tracked, their actual purchases are not being blocked really. I think when
Mhm.
people actually get blocked is when they change their behavior pretty substantially. So if someone says you can't buy this, you can't buy this, they're looking to say, well, what technology could I use that would allow me to buy this? Which then the government's now doing whack-a-mole. Their job is now much harder. Whereas if it's just in the system, they can just kind of do whatever they want. Things can just kind of happen to you. Whereas if you're using money that's inherently more resistant or more peer-to-peer, that the onus is on the government. And the reason banks are so easy to control is because there's not that many of them. I mean, it's easy if the government tells, all 4,000 banks you can't send money to this country, at that day, just all money to that country stops, right? They all obey because, of course, they have to. Whereas now that open source money is an option, the challenge is that you'd have to enforce that on the individual level too. You'd have to say it's illegal for any citizen to send money to that country, which the number of enforcement points go up from 4,000 to 330 million, right? And of course, it's, if only a small percentage of people are doing it, it's easy to track them down. But if it's something more benign, like buying beef, and people are doing it, it becomes increasingly unpopular to try to enforce.
Yeah, I think that's over time. I think in the short term, people have to acknowledge the fact that there's no way they're going to be able to buy the majority of their goods and services outside of that system. Well, let me take that back. There's no way they'll be able to buy the majority of their goods and services using Bitcoin or gold. Now, I do think that they could do it using cash. So, and now will they ban cash? I don't know. That's another rabbit hole we could go down. But assuming that they don't for a moment, and they don't ban the on ramps and off ramps and all that stuff, I think what I would do is, to your point, I'd have to have a bank account at the Fed. I mean, if that's the only option, you got to have a bank account, and then I would make my money depositing into that. Then I would leave as little in there as possible. And then what I would do, I'd only make payments that I couldn't use with Bitcoin, gold, cash. And then I would take the balance and I would put it into gold and or Bitcoin silver. And then I would hold that as kind of the store of value. And then when I needed to make transactions, I would try to take that gold or Bitcoin, turn it into cash, and then use cash for whatever payments I needed to make from vendors that didn't yet accept gold or Bitcoin. And then I would do that until a time where the ecosystem or the infrastructure would build to a point where I'd be able to use Bitcoin or gold for a greater percentage of my overall transactions.
Yeah, and it will be a spectrum because, so for example, now there are power users that are able to minimize their bank usage and live, almost exclusively off Bitcoin. But it's obviously very, very hard compared to. It's
Yeah,
not
you'd have to
something
live like the Amish. That's the example I always use.
they have to use various, yeah, there's like things like bit refill and stuff like that services they can use. And I think the key thing is that in the specific areas they get blocked, that's where you're likely to see the fastest proliferation of merchant acceptance for non-traditional types of payments, because they're the industries that are most impacted. Like, let's say there's a beef quota, for example. Well, the rate of selling beef in non, CBDC terms is probably going to increase a lot, unless,
Right.
again, unless they can pass separate legislation to try to make that illegal.
Right.
Because they're the businesses that literally, if they don't accept those payments, they're, let's say they're only doing physical cash. Well, then they can't ship nationwide up to beyond a certain point. Whereas if they can accept Bitcoin, they can say, well, I'll send you half a cow, and they can still do that. And so they have a faster incentive. Whereas if you're in an industry that's not impacted, if you're just, if you're selling solar panels, maybe you're not impacted. And so you're not going to be probably one of the early adopters to want to move over to these non-CBDC payment
Right.
methods.
Impacted by the climate score, the social score.
Yeah, whatever the case may be. And I
Yeah.
think, the challenge is that, we've seen BlackRock even kind of walk back the ESG stuff a little bit. The brand got
Yeah.
I think the brand got tarnished enough. And
Yeah. Agreed.
I think we'll see a similar thing with CBDCs, or at least I hope, or at least I
Well, I
think
think
that's
it's already tarnished. I think the
yeah.
CBDC brand it's one of the most toxic brands.
Yeah.
It's as toxic as the World Economic Forum right now.
Yeah, and I think that's useful because that can slow them down and that can make legislation harder to pass. And it's just, I think the best people can do is just kind of gum up the works, don't make it easy for them.
Yeah, there you go. All right, Lynn. So please remind everyone where they can go to find out more about what you do. The blogs that you have is awesome, and the book.
So I appreciate that. I'm at lynnalden.com. People can check out my work there, both free articles and a research service. And then the book will be out a little over a month from now, like 4 to 6 weeks, late August, probably. And so people can check that out. I'll have links to it on my website, and you'll be able to find it on Amazon and eventually elsewhere.
And it's called Broken Money. Is that correct?
Broken Money. Yes.
Broken Money by Lynn Alden. Okay, we
Yeah.
got to look out for that, guys. That's going to be awesome. All right, Lynn, thanks for your time. Can't wait to do it again.
Yep. Thanks for having me.